Hey traders, Desmond here. Welcome back to the IronFX Trading Podcast. Today we are answering a question that sounds simple, but it can make or break your risk management. Which markets have the highest volatility? Here's the thing, volatility is just movement, big candles, fast swings, sharp reversals. That can be a gift or it can be a trap. Think of markets like roads. Some roads are smooth highways, others are mountain roads in the rain. If you drive the mountain road like it is a highway, you crash, right? So let us define what we mean by volatility. Volatility is how far price tends to swing over a period of time. Higher volatility means bigger daily ranges and more sudden spikes. Lower volatility means tighter ranges and slower moves. And volatility is not constant. It expands around, major news, right? It compresses when markets are calm. So when we say highest volatility, we really mean markets that regularly move a lot. Let us start with the usual number one. Crypto. Bitcoin and Ethereum can swing hard in a single day. And smaller coins can move even more because liquidity is thinner and sentiment flips fast. Crypto trades around the clock, which means momentum can run without a natural pause. The opportunity is obvious. Big movement can mean big setups, but the trap is also obvious. Crypto loves long wicks. It loves sudden liquidations. Right? You can be right on direction and still get taken out on noise if your risk is not calibrated. Next up, commodities, especially gold and oil. Gold can sit quiet for days, then explode when inflation data or central bank expectations shift. Oil can spike on supply headlines, geopolitics, or inventory surprises. Here is what makes commodities tricky. They can respect key technical levels beautifully, then rip straight through them on news, right? If your position size is too big, one spike can wipe out a week of good trading. Now let us talk indices. Markets like the Nasdaq 100 and the S&P 500 can be very volatile, especially during earnings seasons or big macro weeks. Indices often have what I call structured volatility. The moves can be fast, but they frequently respect trend, momentum, and major support and resistance. That is why many traders love them. You can get clean movement without the same level of chaos you might see elsewhere. Now, Forex. A lot of traders assume Forex majors are the most volatile. Usually they're not. Pairs like Euro-Dollar can move well, but they are often smoother because Vida's liquidity is deep. In Forex, the higher volatility usually shows up in crosses and high beta pairs. Think pound yen, euro yen, and other yen crosses. Right? These pairs can swing hard because they are sensitive to risk sentiment, and they can move fast when traders rush in or rush out. So if you want a simple ranking, it often looks like this. Crypto tends to be the most volatile, right? Then commodities like gold and oil, then major indices like the Nasdaq 100, or then volatile Forex crosses like pound yen. But here's the part most traders miss. Volatility alone is not the goal. The goal is tradable volatility. A market can move a lot, but if spreads are wide, slippage is nasty, and price is full of random spikes, you do not actually have an edge. You just have stress. Let me give you a practical example. Imagine it is a major United States inflation release day. Euro-dollar might trend, but it often does it in a more controlled way. Gold might spike up, then slam down, then reverse again. If you trade gold with the same stop size mindset you use on Euro-Dollar, you are basically bringing a butter knife to a sword fight. This is the real secret. Your position size must match the volatility. Higher volatility means wider stops. Wider stops means smaller position size if you want the same risk per trade. That is how professionals survive volatile markets, right? They do not handle volatility with courage, right? They handle it with math. Now let us talk strategy fit. If you are a newer trader, chasing the most volatile market is usually a mistake. You want a market that is liquid and reasonably structured. That is where you learn execution, patience, and risk control. If you are intermediate and you want more movement, you can step up to gold or a major index. But you must reduce size and you must respect the volatility. If you are advanced and disciplined, then yes, crypto and the wild markets can be a good hunting ground. But only if you have hard rule, a maximum daily loss, a maximum number of trades, and the discipline to stop when conditions are messy. Here is my hot take. Good traders do not pick the most volatile market. They pick the market where their edge is the cleanest, right? Because volatility is not a cheat code, right? It's leverage. It amplifies skill and it also amplifies mistakes. So, which markets have the highest volatility? Crypto is usually at the top. Commodities like gold and oil are next. Major indices like the Nasdaq 100 can be very volatile, right? Especially in risk on and risk off swings. And in Forex, crosses like pound yen often carry more volatility than the major pairs. Right? The final question is this: can you control your risk in that market day after day? If the answer is yes, volatility becomes opportunity. If the answer is no, volatility becomes a fast way to blow up. That is it for today. Thanks for listening to the IronFX Trading Podcast.